We got it.
It's Monday.
So rate update. Rate update. Let's give you a rate update of what's going on right now. So this morning we've already had a lot of news. Stock market's up like 700 points right now. So we're seeing a yo-yo, and that's just it just happens. Whenever you have big swings in the market, you've got people selling off, and then you've got people buying back in at what they think is a good price. I mean, we saw major names lose 25 to 30% of their value over the last couple of weeks. So it's been interesting. So a lot of investors jumping in now. Anytime there's big moves in the market with Wall Street and with the stock market, people are taking money out of bonds and putting it back into the equities. And we see little bumps like this today. So we were already down 42 basis points, and we're getting a little bit better now. But let's look at the charts. We're seeing this step ladder down in the mortgage-backed securities market. So we expect it to continue with these little head fakes, I call them, where you can capitalize on locking in some loans at the peaks here to get a little bit more pricing back to make it cheaper on interest rates. And then we see days like today where we're losing a little bit. So that little triangle here is an alert to lock that we get before rate sheets change, to lock our loans in before we see negative pricing. So rates based on today will probably get an eighth worse by the end of the day today, just because we lost that pricing. So that's kind of a bummer. But here's an overview of where we're at interest rate wise nationally. We're at 30-year fix. We're in the low fives, 5 3/8, 5.35 with points. That's with 0.40 points. So a rate with no points is right around the 5.625 on a 30-year traditional conventional loan. 15 years, a little bit less, 4.78 again with points. So you're closer to 5% with no points. 30-year FHA, we're at 5. FHA is always better. And again, this is from Mortgage News Daily, and this is an average across the nation. Jumbo, we're in the high 4s. That can range. There's a lot of different jumbo investors. Some have higher rates, but they accept a lot more of the more unique scenarios. And then adjustable rate mortgages, we're going to talk a little bit about that today, in the mid 4s with points, closer to 4.75-ish with no points. So that's kind of where interest rates are roughly across the nation today. I'm going to skirt back into my rate update here, my presentation, and if I can keep this going here. All right, so the market. We still have a hot market, guys, and if you haven't been watching, this is really interesting. 20% of all the sales in the fourth quarter of last year were investors. 20%. In Maricopa County, 30% of all sales were institutional investors in the fourth quarter. Guys, that is a big number. And I want to show you something. 75% of all apartment buildings and multi-unit are owned by institutional investors. So they control that market. There's a lot of speculation that, well, what if they continue to do this? Will homes be in the same bucket in the future? Will institutional investors continue to buy? And it looks like the trend is continuing. As buyers think it's too expensive, the institutional investors, they've got cash. They'll just come in and buy them anyhow. And then that's what controls the rents as well. So we need to really be watching that. I honestly think that owning a home is has been the American expectation. Everyone thinks, yeah, we're going to all own a home eventually. It used to be the American dream, like owning a home was unique and it was a dream. And when we got a home, finally, it was like, we made it, right? I think that's going to slowly become the American dream again. I hate to say that, but as investors and as institutional investors keep buying properties, they're going to pull these properties out of the pool. And as they remove them from the cycle, it's going to create an even larger supply problem as well. And then supply and demand. I mean, that's what's going to continue to drive appreciation. So let's kind of see what we have right now. We are down in volume, but I'm going to go over that. We're still really high numbers. We're down in volume by about 5.9% year over year, but that's compared to having one of the hottest markets we've ever had. So it's still really, really good. Median home price is up 15% year over year so far. The days on market average is 17 days right now. Inventory is still only 2.2 months. So this is nationwide, guys. This is not just based on Arizona. Arizona is a lot more intriguing. So watch the Cromford Report meeting that we have coming up. And then first-time home buyers are declining. They used to be 30%. They're down 28%. We can always kind of figure out why just by the level of entry with prices being higher, needing extra money at closing. to go bid over ask, etc. So here's the number of existing home sales. I want to show you guys this. So we are right over here in this corner here. Let me move this out of the way. We're at 5.61 million. We're right in here. We're right on this black line, which is really good. I mean, over the last years, we've been below this. We're still right on it, which is epic. I mean, we're still in a really, really good market. This was COVID. This was the jump into homes because of COVID, the great equalizer, the scattering around of everyone in the country. And now we're kind of back to this point right here. It's still really, really good, historically speaking. So just want to make sure you guys see that. Inventory. Look at this. It looks like the scales on an alligator's back. But look at these trends, the seasonal trends. So inventory continues to drop. And we're on the upscale right now of inventory. So you guys have probably seen the inventory climbing, but it climbs every time at this time of the year. Every single cycle, it climbs this time of the year, every single cycle. So when people say inventory is going up, there's going to be a crash. No, it's normal. This is the buying season. This is when people move. It just happens. That's what happens when people graduate from different schools. They want to get ready. They want to move during the summer so that next year they're ready and they already are in the home before the school starts. So it's cyclical. It's cyclical. It happens every year. We will see more inventory here. So we'll keep an eye on this. But as you can see, inventory is still low. Vacant properties. If you were to ask me what is the #1 reason why people lower their prices on homes for sale, typically it's because they're holding additional properties like they were in 2008. A lot of people owned investment properties. They weren't living in them, but it was a cost. Every month they were paying for mortgages. So they wanted to get rid of them. So what did they do? They put them on the market, and then they kept lowering the price just to get rid of them because the cost of holding them was expensive. The number of vacant properties right now is at an all-time low. Check out the vacant properties. We're down here. I mean, this is compared to all of the years before. We are an all-time low for vacant properties. So there's not going to be these giant price reductions in properties because people aren't carrying homes that are vacant anymore. It's at an all-time low. So that's a really interesting stat. I thought you should like. The Fed are very active, guys. Remember, their job is to slow down inflation. They want to do that. Higher cost of money, slower economy, higher jobless numbers, and lower stock market. Those are all things that are going to happen as the Fed moves forward. So they are basically pushing us towards a recession or close to a recession to cool down the nitrous, to pull it out of the system, right? To go back to a normal market. We've been living on nitrous and all these stimulus for so long. That's gone. So now people are coming back to reality. But the Fed is going to be acting very strong. June 1st, again, 50 basis points. July, another 50 basis points. We're going to see really what happens. What we want to watch for is this Fed group is very wishy-washy. They're not as all in as other Fed groups have been in the past. So look for the word pause. Look for the word pause. If you hear the Fed say they may pause, that's because they're afraid of a hard landing. They're afraid of the impact of raising interest rates on the market, pushing us into a recession. So that pause will be a good point of us to realize, okay, now we're back on the mend, maybe in the equities. That's a signal for equities to move back higher. So we've seen a crazy move back. It's kind of a bear market right now. So here's what's happening today and this week. Tuesday, we've got auctions and treasury auctions. Wednesday, the Fed minutes are released. That's going to be really interesting to see behind the scenes of what the Feds are doing. And then Thursday, we've got GDP price index, Prince index. No, it's not a Prince index. It's a price index. That's sorry for that. Again, 5 a.m. We have continuing jobless claims, another bond auction, pending home sales. And this is based on higher interest rates of last month. So we'll see how that number is. And then Friday, we've got the inflation numbers. So Friday is going to be a big day, guys. I'm hoping that those numbers are low. We expect them to be low and then spike again in the summer. So working with buyers, how can we in this market educate our buyers and show them exactly what's really happening and help them get off the fence and really take advantage of the opportunities that are still out there with owning a home? We really have a couple tools. We have data, which will help Psychology is a big thing with purchasing right now. So I want to go over that a lot. And expectations. We're going to look at buy versus rent. We're going to look at the cost of waiting, and we're going to look at seller buy downs. And then what I call a call to arms. Adjustable rate mortgages are becoming more popular. And then some loan tools that we have, True Cash, True Offer programs, and then bridge loans. So let's start with the first thing. I want everyone to understand the psychology of what this means to people. If you look over the decades, right now we're at 5.30 average. In the 2010s, the average was 4. In the 2000s, it was 6.25-ish, the average rate on a mortgage rate. So if you look, yes, this was a good run, but we're still below average on what the average is for decades here in the United States for mortgage rates. I think this is a very telling chart, one that may be really good to share with your customers, with your buyers, to kind of get them into the what is the expectation of interest rates, what can we expect in the future, what's normal. This is a really good chart to show that. Here's an interesting year-over-year change in home prices and what the appreciation levels are according to CoreLogic and Fannie Mae. Fannie Mae's 2022 is an expected 10.8. I honestly believe in Maricopa County, it's going to be way above this. And then nationally forecasted for 2023 is going to be back to normal. Normal, guys, is between 2 and 4%. So, which is supposed to mirror the inflation numbers. So honestly, I think Phoenix is in a really unique position. So we're probably going to be higher than this. So this is normal, guys. We're getting back to normal, which is a very good sign. Notice none of these are negative. None of these show that we're going to lose value. It's continued appreciation, just at a slower, more normal pace. These are the things we need to be sharing with our buyers. Here's an interesting buy versus rent number. Buying is a hedge against inflation. And why? Because your mortgage rate won't change. Taxes and insurance will, but the mortgage rate won't. So you're betting against inflation. And look at these rents. Look at these rents. Look how high these rents are climbing. It's a pretty big spike. So you can show this to your customers, say, what is the option? If you don't buy, what are the options? This is what rents are doing. It's crazy. It's pretty wild. They're up 25% year over year in Phoenix. And guys, Wall Street's buying homes. Institutional lenders are buying homes like they're going out of style. So do buyers know more than Wall Street? That is my question. Like, what do you know that Wall Street and all these institutional investors don't, right? They study this for a living and they're buying. And that's the question. Will a majority of homes be owned by institutional investors in the future? Well, if that is the case, you definitely want to own with them. You don't want to bet against them. And are the costs of renting being controlled by institutional investors? Well, if they're going to be owning a majority of the properties out there, they can set rents as well. So you want to own and not rent. You don't want to be controlled. So this is a really good representation for rents. So this is a rent versus buy calculation that I have. This is just snapshots of the report, but this is renting versus buying. If you rent at $4,250 versus buying, which is still cheaper right now, and this is based on a $750,000 purchase, what are the gains? How much are you actually making? Well, when you buy, you actually pay yourself every month and you build equity that way. Plus you have appreciation. So overall, over a 5-year period, you're seeing $193,000 benefit over renting. These are really, really interesting charts that you can present. I highly recommend you get one of these in your listing and buyers presentations because they are factual, they are data that is hard to refute, and it really is good to make you look like you know exactly what you're talking about when talking to buyers. And it really, really helps people understand what they truly lose by waiting. And that takes us into the next one, which is the cost of waiting. If you said, you know what, I'm going to wait for rates to go down, or I'm going to wait for next year, I'm going to wait till there's more homes on the market, what is the true cost when you're working with buyers? Over 6 months, or a $35,000 cost of waiting. Over a year, it's $63,000. Again, this takes into consideration appreciation, the amortization that you're paying yourself every month when you have a mortgage. You're losing all of it when you rent. And this just shows the cost over a 3-year period of what it costs to waiting. All of us know buyers that in the past, in the last year or two, have said, I'm just going to wait for rates to come back down or whatever it might have been. Yeah, they're kicking themselves, and they will continue to kick themselves as we move forward. And then here's a seller buy down. Guys, this is magic. As the market continues to soften, and when I say soften, there's going to be more homes on the market. And instead of going $100,000 over asking, we may just have full price offers again and a normal market, right? This is a comparison between a full price offer and asking for $20,000 under asking compared to doing a full price with a $20,000 rate buy down. Look at the rate difference, 5.625 to 4.5. We're really comparing these two right here. That's a huge difference in rate. And look at the payment difference is like close to $400 difference in savings between these two. So a way of getting your customers a really good rate right now is the seller buy down. If you copy this link right here, guys, I'm going to copy it. I'll actually email it to everybody. But this link right here, if you click on it, I'm going to send this PowerPoint to everyone as well. It'll take you right to the online report. I went back one. It'll take you right to the online report. That's the full report that gives you all of the details of this scenario. I also want to show you ARM products, because if you're working with buyers that are scared of rates right now, the seller buy down is a great option. But if the sellers aren't willing to work with you, let's look at an adjustable rate mortgage. A 30-year versus a 7-year, you're almost a full % in rate difference. And look at the payment savings, $300 plus that you're going to be saving, or $300 savings per month. And the average life of a loan in the United States is only 5.88 years. So people move, they refinance, they sell, they do all kinds of different things in the middle. So the average life is 5.88 years. So really a 7-year ARM and a 5-year ARM are very viable options for you, for your buyers. So we want to really look at that as alternatives when buying to those that may not enjoy the higher rates right now. It's a great way of getting into a lower rate. So it's a great tool. Make sure you're presenting this to buyers if they are rate sensitive. And again, this link right here will take you directly to this full report. This, guys, is a true offer program. It has a closing guarantee. This is something that we're offering internally. If you get the loan fully approved up front, we can close in 2 weeks. There's a guaranteed closing on time. And really, it's a fully approved loan. It's basically a same as cash offer. And here's the terms and conditions on that. We really want to position your buyers to be the best offer possible. This is one way of doing it. It can be co-branded, like over here. You can show this to your customers in buyers' presentations on how it works. Here's a little bit of the details. It has to be fully approved through underwriting. And then we are coming out with a true cash deal where we offer to buy the property for them. The details of that will be coming out shortly. So that's something that I think will continue to help this market. But if you're not doing this for your buyers with getting them fully approved up front, if you're letting them kind of dictate what they do by just shopping without getting pre-qualified, which I helped a couple people this weekend with, it's kind of a rat race. It's really fast paced. It's last minute. People get frustrated. And it's not a fully approved loan. This, guys, will really help you get into the driver's seat. So it's a lot of things that are coming out right now to really help. These tools will really help you guys working with your buyers. It's important that we present all of these to them and really help them as we move forward. So I hope that those tools will help you. Let me answer some questions real fast. Do they need a high credit score for an ARM? Typically, yes. Higher interest rates, higher credit scores will definitely help the rates on adjustable rate mortgages. The way that their pricing works on adjustable rate mortgages is a lot different than 30 years. So there's not the spread on what you can buy down and what the loan level adjustments are for a low credit score. Typically makes it so ARMs are not attractive if they have low credit scores. So very good question. I'm going to open it up for questions, guys. Any questions on any of those tools that I presented? And I'm going to send this to everyone just to let you know. Don't be shy. So as far as predictions on interest rates, I honestly feel that we're going to get maybe a little bit better. If the inflation numbers are better on Friday, rates will have a little bit of a head fake. But this summer, we're going to be replacing higher inflation numbers with what's been recorded a year ago. And I think we're going to see a little spike in inflation this summer. And then October, I think we're going to see inflation really be under control and maybe rates come down. So if you guys have people that are in new builds, long term, I think rates are going to come down a little bit, but the short term, I think we're going to see rates improve in the short term, maybe through next week, maybe rough this week, depending on what people are speculating for the Fed, for what the Feds do, and the numbers on inflation. But summer, it's going to get a little worse and then better after that. So that's my crystal ball. And I have been right so far for the most part. And we've been talking about a potential recession, which is always good for interest rates. And if people are trying to tell you that a recession means that values are going to drop, they need to know that every recession except for 2008 showed appreciation in homes. 2008 was not a true recession. It was a housing crisis that led to a recession. So a lot different, a lot different. So any questions?